Many people think stablecoins are exempt from taxes because their value is pegged to the US dollar, but that's a huge misconception. The IRS sees stablecoins just like any other property, not currency. This means every time you use them, you could be triggering a taxable event. With new regulations on the horizon, this isn't something you can afford to ignore. In this video, we'll dive into the upcoming Genius Act, how it will impact your stablecoin taxes, and what you need to do to stay compliant. We'll also cover the new Form 1090/90A and why even tiny price fluctuations can create significant tax liabilities. Stick around to learn how to avoid costly mistakes and keep the IRS off your back. The digital asset world is changing fast, and the US government is catching up. The Genius Act, or the Guiding and Establishing National Innovation for US Stablecoins Act, is designed to bring stablecoins under a federal regulatory umbrella, treating them more like traditional financial institutions. The goal is to ensure financial stability, establish federal oversight, and combat illicit finance through strict anti-money laundering and countering the financing of terrorism requirements. In early 2026, the U.S. Department of the Treasury and the Office of the Comptroller of the Currency, or OCC, took significant steps to implement this Act 1. They released proposed rules to define these new standards, and the public comment period for this proposal is set to end on June 2nd, 2026-3. These rules will increase data collection on stablecoin issuers and exchanges, which ultimately means more data for the IRS on your transactions. Now, here's where it gets real for your taxes. The same data used to prevent financial crime under these new AML rules is exactly what the IRS will use to verify your tax returns. The Infrastructure Investment and Jobs Act of 2021 mandated that digital asset brokers, which includes most centralized exchanges, must report your transaction data to the IRS form. This reporting will happen on a new form called Form 1090/90A, Digital Asset Proceeds from Broker Transactions 5. This form will include your identity, gross proceeds from sales or exchanges, and often your cost basis. When your exchange sends a Form 1090/90A to the IRS, their automated systems will cross-reference that information with the gains and losses you report on your Form 8949, Sales and Other Dispositions of Capital Assets 6. Any mismatch can trigger an IRS notice or even an audit. So, accurate reporting is more critical than ever. Beyond just reporting, these new rules also bring sanctions compliance into play. The Treasury's Office of Foreign Assets Control, or O, maintains a list of sanctioned individuals, entities, and even crypto addresses. Stablecoin issuers and exchanges are required to block transactions with these addresses. Imagine this. Your funds are frozen, or a transaction is blocked because of a potential sanctions link. This creates a really complex tax situation. You might have lost access to your assets, but can you claim a capital loss? And when? It's not straightforward at all. These scenarios demand meticulous documentation and often require the help of a tax professional. It's another layer of complexity that underscores the need for precise record-keeping in the stablecoin world. The biggest mistake people make is thinking stablecoins are tax-exempt. But the IRS, in its Notice 2014-21, clearly states that crypto is treated as property for tax purposes, not currency 7. This means anytime you dispose of a stablecoin, you're likely creating a taxable event where you need to calculate a capital gain or loss. This gain or loss is the difference between the fair market value when you dispose of it and your original cost basis. Common taxable events include selling a stablecoin for fiat, like swapping 1,000 USDC for $1,000 USD, or exchanging one stablecoin for another, like trading USDC for USDT, even using stablecoins to buy other crypto, like ETH, or purchasing goods and services, triggers a taxable event. If you receive stablecoins as income or earn rewards from lending or staking, that's also taxed as ordinary income. Here's the thing, even if a stablecoin perfectly held its $1.00 peg, high-volume trading could still result in small, reportable gains or losses. But in reality, stablecoins rarely maintain a perfect peg. They fluctuate by fractions of a cent due to market dynamics. While these minor fluctuations seem insignificant on a single transaction, they add up. Let's say you buy 1,000 USDC when it's priced at $0.9998, costing you $999.80. That's your cost basis 8. Later, you use that same 1,000 USDC to buy ETH, but now the USDC is priced at $1.01. Even though it's a stable coin, you just realized a gain of $0.30. Now, imagine doing this across thousands of transactions, which is common for active traders. Manually tracking these tiny gains is a nightmare and a recipe for errors. This is why automated software is absolutely essential for accurate reporting. You might have heard about a Minimis exception for crypto reporting, but relying on this can be a trap. The IRS has provided some guidance, suggesting that brokers might not have to report transactions below a certain threshold on Form 1090-90A. However, this rule is complex and has critical limitations. First, it primarily applies to what brokers report to the IRS, not necessarily what you as a taxpayer are obligated to report on your own returns. Second, the scope is often very narrow, intended for specific use cases like minor purchases with crypto, not for trades between different digital assets. Misunderstanding this rule could lead to significant underreporting and potential penalties. The safest approach is always to meticulously track and report all your stablecoin dispositions, no matter how small. This is where tools like dTax become incredibly valuable. With all these new regulations and the complexity of stablecoin taxes, managing your crypto portfolio can feel overwhelming. That's where dTax comes in. dTax helps you navigate the new Form 1090-90, a landscape, with its 1099-D, a reconciliation center. This feature lets you match broker-reported information against your on-chain records, helping you detect discrepancies and flag covered versus non-covered basis. We support 22 blockchains, including 16 EVM chains, Bitcoin, Bitcoin Cash Dash. Plus, we offer 13 cost basis methods, like FO, and specific ID, and 29 CSV exchange parsers to make importing your data easy. Our best method can even compare all 13 cost basis methods simultaneously, showing you optimal tax savings. And with the pre-audit sandbox, you can scan for 6 IRS audit risk categories before you even file. You can also generate an audit defense PDF with a full transaction register and on-chain provenance for any IRS examination. dTax offers a free tier with unlimited import and 5 AI chat queries per day, or you can upgrade to the Pro plan for $49 a year or $199 lifetime for unlimited everything. Check out .com, it's open source and free to start. Let's answer a few common questions about stablecoin taxes. First, are stablecoins considered capital assets? Yes, the IRS treats all cryptocurrencies, including stablecoins, as property, which means they are capital assets subject to capital gains and losses. Second, do I need to report stablecoin transactions if I never sold them for USD? Absolutely. Anytime you exchange one stablecoin for another crypto, or use stablecoins to buy goods or services, that's a taxable disposition. The key is disposition, not just selling for fiat. Third, what if my stablecoin only moved by a fraction of a cent? As we discussed, even tiny fluctuations can result in a taxable gain or loss. These add up, especially with high transaction volumes. You must track and report these, even if they seem insignificant individually. It's better to be precise than to risk IRS penalties. So, there you have it. The Genius Act and new Treasury rules are changing the game for stablecoin taxes. With the IRS getting more data through Form 1090-90A, meticulous record-keeping and accurate reporting are no longer optional. Don't let the stable in stablecoin fool you. Every transaction can have tax implications. Make sure you're prepared for 2026 and beyond. If you found this video helpful, please give it a like and subscribe for more crypto tax insights. Thanks for watching, and we'll see you in the next one.